President of Titan Capital Holdings. We're a private money lender. I'm going to walk you through how we originate performing notes. Dialogue is helpful, so if you have questions at any point, ask me questions. And David, am I good? Good. Okay. Ask me questions. Let's have some discussion like we've been having, and makes it good for everybody. So, Titan Capital Holdings, how to profit from real estate without buying it, selling it, or being a landlord. That's what you were just talking about. Ash, anybody else? Our agenda today, we're going to talk about note basics, how we create our notes, what investors look for in notes, and why buy notes. Now, if you don't mind me asking, you're generating some notes. What do you look for when you produce your notes?
I'm not generating notes right now, but
you're not?
No, I mean, I would just look at the value of the security behind it and the interest rate, basically.
What you can earn on it and how you're secured.
Right, exactly.
All right, come on in. We just got started.
Hi, so sorry.
No worries. I'm Adam Child. I'm the president of Titan Capital. Welcome.
Thank you.
Get that last text or email sent off. Two more stragglers. How you doing?
Hi.
But that's exactly right. You're looking for security and you're looking for income on that. Investments 101. You make an investment, what are you looking for? You're looking for control or no control. Now, I'm a student of finance. I've been a direct lender, mortgage broker, mortgage banker for 24 years here in Maricopa County. I studied finance at ASU. I got out of college with the idea that you buy mutual funds, IRAs, stocks, bonds, things like that, and I did some of that. Anybody else do some of that? Probably we all have at different points in time. Control versus no control. One of the things I learned is that I had Microsoft stock. That was neat, but I had no control over what was going on with it. I had stock in GE, had no control over what was going on with it. On a tip, I bought a little stock for $1 that ended up going to about $29 a share before I bailed out of it. That was a great tip and it gave me a great return, but I didn't have any control over it. Make sense? Real estate is something you can hold, own, control, manage. Notes, which are income parts of that real estate transaction, the same thing. So control versus no control. What kind of an investor do you want to be? Do you want to be passive or do you want to be active? A little bit about Titan Capital Holdings. We've been around since 2009. Fortunately for us, we formed just after the real estate crash. So in that period of time, we've made now about 325 loans. We've had 5 defaults with no losses. So less than 1% default. You're going to have defaults. If you're a lender, you're going to make a loan, there's going to be a default, you're going to have a foreclosure. We've had 5. As far as I'm concerned, that's 5 too many, but it's well below the industry average, and it's a manageable amount, and none of our investors have lost any money. So the original company here that we have, you may have heard of, is Infoclosure.com, formed 15 years ago to help investors pick up properties at public auction. If you've not heard about that, we do separate seminars on training how to buy at public auction, and again, Infoclosure's been around for 15 years. In 2008, 2009, we discovered that our Infoclosure clients needed money, and they were going to our competitors to borrow money to buy properties through Infoclosure at public auction. We got together with our initial investor who wrote a $4 million check to put us in business and get us started. Since then, it's grown. We've got Look Inside Realty, so Infoclosure.com, Look Inside Realty, and Titan Capital Holdings all under one roof. 3 companies that complement each other very well. Generates a lot of business for each of the respective companies, but today we're talking about Titan Capital in our notes. And by the way, you guys snuck in late, but there is food and water and everything else if you want. So, Titan Capital Holdings is a licensed mortgage broker and direct lender in Arizona and Nevada, and we're being processed right now in California. So we should be licensed and set there very soon. Why is this important? We were having this discussion, I think I was having this discussion with you two gentlemen earlier on, but there's a lot of rules and regulations and state banking guidelines coming down. It's going to make it more and more difficult, more and more regulatory. You had mentioned that you just got under that a little bit by making some loans yourself. Again, I've been a licensed direct lender since 1989. So we're licensed in Arizona, we're licensed in Nevada, we're governed by the banking divisions, we follow the safe harbor rules. Our borrowers, even though we're a hard money lender, private money lender, we still do applications, we still do profiles. I still get borrowers calling up going, how come you do all that? Don't I usually just give you the money and you give me the money and we go get a property and it's all okay? We can't do it like that as much anymore. We can, but we're going to get fined, we're going to get audited more frequently, we're going to become more scrutinized. So we make loans. Now we make loans that banks don't make, but we still put them together like loans with applications, with credit reports. Our loans have personal guarantees. You know, we check the property, we check the borrower, we make sure that there's a strategy to and the ability to pay us and pay us off. And that's probably why our default rate, one of the reasons our default rate is so low. Performing versus non-performing. You know, there's really, our notes are performing. And the part of what we do that I'm here to introduce you to today is performing notes. But we were having this discussion earlier. There's really three types of notes you can buy. You can buy a non-performing note. And just for simplicity, let's say there's a bank who has a $100,000 note that's not performing. They're going to either foreclose on it or they're going to restructure it or do something like that. You can go to that bank and buy that $100,000 note for $50,000. You take it over and you do what you want to do. You foreclose on it, you restructure it for the borrower, make it performing, then resell it again however you want. But there's different ways that you can handle a non-performing note. We're not in that space. Then there's discounted notes, which let's take a similar example. Let's say we issue a $100,000 note on a $150,000 property, and now I'll sell you that note for $90,000. That's a discounted note. Well, why would I sell that note to you that I did a $100,000 loan on? Why would I sell it to you for $90,000? Probably because I've got another use for that $90,000 that I can generate a better return on, so I'll take a discount, give you a better return, but you're still getting a $100,000 note, but for $90,000. So does that make sense? So you've got performing, I really should add discounted, and then non-performing. Our notes are, we're the direct lender. So we've made a $100,000 loan on a $150,000 property. We've already done all the due diligence. We've done the borrower, the appraisal or the BPO or the inspection of the property or all the above. We've done our market analysis. We've put everything together. We have clear first title position. We're listed on the hazard insurance. It is a true, complete, comprehensive mortgage, if you will, okay? And it's performing. So we've made that $100,000 loan on that $150,000 property just as an example. But what's happened in our situation? Well, in our situation, we have almost $10 million under management here, okay? But we still have a demand for our loan product exceeds our available capital. So what's the next easiest thing to do? Investors like to buy notes and generate a return, especially when the note's secured by a first position lien on a good piece of real estate, right? So if I do nothing, we just sit and we're okay. We're maxed out. We're fully deployed. We're making 14, 16, 18% on our money depending on how we structure the deal. And we're getting paid and I can go golf or go hike and do whatever and let the checks come in and everything's fine. But we have a tremendous amount of deal flow because of our real estate company, because of InfoClosure, and because of my 24 years of doing loans here in the Valley. So now I reach out to you and I say, you can buy this note for $100,000, but it's $100,000. It's a performing note. It's not discounted. It's not non-performing. We issued it for $100,000. You're going to buy it for $100,000. You're going to take over our first position lien by an assignment to the deed of trust. So you're taking over first lien position. We do an endorsement to the note. So you're getting 10.5% net. Okay, so if we did that note for 18%, we're getting 7.5%, but we're covering all the expenses. And then we're making sure the payments are coming in and everything else because we're still tied to that with you. We service everything we issue here, but once we sell the note, all the servicing goes down to Security Title on Central. Good question. As soon as we sell the note, it becomes a banking instrument, and we have a brokering license. We don't have a banking license, so we send that servicing down to Security Title. Plus, it puts a third-party servicer in there, which I think is better for our note buyers, better for us. So the borrower's checks go to Security Title, and we send all the documents down there, and Security Title sends out 2 checks a month, one to you and one to us. If it goes to foreclosure, you know, and it depends on the note buyer, but we offer to take care of that all the way through. we'll take everything cradle to grave for you. So if there's a foreclosure situation, I mean, if a borrower's late, I'm calling them up. You know, because we're tied to these notes with every investor that we have. Our investors are getting 10.5%, and if we've issued that note at 14 or 16 or 18, we're still in there to some degree. So we're still counting on our income in there, and we're counting on our income to pay the servicing costs and do all the rest of that stuff. So if there's a default, I'm on the phone, making sure those payments come in. If we've got a borrower who's going south and you're the holder of the note, well, we originated it with you, but we're going to help you through that right to the finish line. I'm going to call you up and go, look, I've made this many phone calls, I've had these conversations, he's not performing, I think we default. And then we'll walk you through the foreclosure process.
So the notice all that are okay. Okay. So if the notice
Go
issued
ahead.
at 18, well, if it's issued at 18 and you sell it at 10, so you sold it at a premium, like a bond sold at a premium kind of.
Well, you take the $100,000 note, you write the $100,000 check, we do an assignment to the deed of trust, an endorsement to the note, a few other documents, it all goes down to security title. The borrower is still making the 18% payment, but now that servicing's all been transferred, right? Servicing transfer, we've all seen that. So the servicing's all been transferred down to security title. We let the borrower know, security title lets the borrower know, they start making their payments to security title. So each month their payment goes into security title, and then you're getting 10.5% annualized. So
Right.
let's just say on 100,000, let's say it's an $1,800.
Title gets a difference, or is there a difference, or is it, how's the deal, I guess, structured? So is the note sold at a premium?
Nope,
No?
not at a premium.
Not at a premium?
At par. It's a $100,000 note, so it's a $100,000 purchase.
Okay.
But it's a performing note that's generating 18%.
So the title company splits the interest between you and.
Correct. We do an endorsement, and we send all those instructions. You get copies of all this stuff, but all the instructions go over to the title company, and it says you get 10.5, which is this amount. Let's just say it's $1,000. So you get 10.5, and $1,000 gets sent to you every time the payment comes in. Let's say there's another 700. We get the other 700 minus the servicing fees, and then that comes to us. So there's no premium. It's
There's
just
no premium, okay.
yeah, we're splitting the income.
All right,
Okay, but you're getting a set 10.5%. And it's a true net yield.
okay.
Okay. No, good questions, and that's what this is all about. So,
Or
Thank
the
you.
underlying recourse or non-recourse?
another good question. Our loans are all recourse. Every note we have is a personal guarantee. So our loans, with the exception of maybe 2 or 3 since 2009, and I don't remember if I did this before you got here, but when we formed in 2009, since then we've made about 325 loans. We've had 5 defaults with no investor losses. So it's an extremely low rate, default rate. One of the reasons I think the default rate is so low is because our predominant loan is to an investor, short-term, 6 and 12 months. That investor's putting anywhere from 20% at a minimum to 50% down on a property. So they've got skin in the game. Then they're putting their own dollars into rehabbing that property and everything else. You know, they're using us as a bridge. You call it hard money or private money, but we're really short-term bridge lender is the right way to describe that.
So most of the things are 6 months, Horizon
6, 12, we do 6, 12, and 24.
or 6, okay.
And right now the lion's share is in 6 and 12. We've got a few for 24.
What is your average interest that you're charging? Does it vary by the project, or is it pretty well fixed?
Our short-term flip product is 18%. And again, depending on the borrower, the loan size and everything else, it's 16 to 18. And somebody was referencing that. You're talking about 12 and you're talking about 18. The market seems to be anywhere from, the regular flip lenders are still 16 to 18. And our demand is so high that we're still mostly 18 on that.
Are most of the properties Arizona, or do you have them spread in other, well, you can only be in Arizona?
We're in Arizona and Nevada, no place else. We have about a half a dozen notes right now in the Las Vegas area. We have a few in the Tucson area. We have a nice commercial property up in Payson, and otherwise we're predominantly right here in Maricopa County.
What happens at maturity? At the 12-month period or 24 worst case
You've
scenario?
got to pay us off or renew. A good question.
So if I buy the note from you,
Mhm.
at the 24 months, I'm going to get in this hypothetical case, my $100,000 back, basically.
Correct. What we identify with the borrower, and that's a good question too, is one, we do take a look at how are you going to pay us, and are you able to pay us, and what's your strategy with the property. I mean, it's a whole comprehensive thing. A little sidebar. We have a regular investor who came to us, and he got this little niche to start picking up burnt out homes down in the Capital District, downtown Phoenix. great little niche, right? But I don't want to put a loan on a burnt-out house. But he had another really nice, clean triplex, fully rented, with a lot of, debt-free. So I put a loan on that property. It's an investment property. We're at about 55% loan to value. And then he's taking that cash and he's going to go rehab his burnouts and things like that. Because I don't want to put my dollars against the burnout, because then the question comes back to, okay, so if it becomes too much work for you and you walk away, guess what? You and I are doing a burnout. I don't want to do that. So, right? But
You're doing multifamily too?
we're doing multifamily, 1 to 4 units. We've got a
Okay.
sixplex on the books, yeah. If it's anything, I had somebody call me the other day on about a 120-unit apartment project. I've got other investors I work with, so I'll introduce that project to them.
Okay.
But predominantly residential, 1 to 4 unit,
Okay.
couple small commercial, short term. But yeah, we talk with our borrowers about that. So if they're doing a 6-month, a year ago, we were probably 90% 6-month flips getting paid off in 120 days, like clockwork. But of course, the margins have gotten tighter, so the short-term flips are not as dominant. Now more of our loans are 12-month. And their exit strategy is either clean it up, put a renter in there, let it appreciate, and sell it, or put an A-paper loan in it. We just had a borrower come in, put 40% down on a purchase. He's a 770 credit score with a regular W-2 job. So he's using our money for probably 3-4 months, and then he'll qualify for an A-paper loan and take us out, right? So
We just consider that part of the cost of the rehab, the interest that they're going to be paying for
Right.
those several months.
and that's a good point too. And our loans are not, we don't have prepayment penalties because we want to get paid back. We like to have the dollars come back in and get them recycled again. So our loans are bridge loans, but they're here to help the borrowers get from point A to point B. We get to the end of 6 months and they go, hey, I need a little bit more time. Well, what's a little more time? I mean, we'll work with them 30 to 60 days if that's what it is. We get to 12 months, they needed it. I just had one of these happen. He really thought he was going to get a conventional loan. He got to the end of 12 months. He was not able to get a conventional loan. We let him roll another 30 days. He couldn't get there. We did a full refinance. So at that point in time, if you're the note holder, again, we're still involved in that with you. So we'll have some discussion. I'll say, hey, do you want to stay in this for another 12 months that might pay off sooner, or do you want out? We'll refinance it for him, and then we'll find another note buyer who wants to come get it. So that, you just have that discussion along the way.
What are the range of note values that you're talking about?
Right now, and I can give you a list when we're done here, you can all get a list, I don't think I brought one in, but I think we're sitting anywhere from, as you mentioned before, a year ago we had a lot of 30 to 50, right?
Yeah, correct.
And with the change in the market, I think our small note right now might be around 51,000. We might have a 32, but that's one of those where he just bought it for 40. I mean, this is a guy we've done a dozen loans for. He hits the pavement, he finds the deals, bought it for 40, put 20% down. We did 32 for 6 months. He's already sold it for 90, and it's already in for payoff. But anywhere from that 30 to 50 up to 200, 240. We have a $305,000 construction loan. It's in its 7th month on a 6-month loan, but it's a guy I've done construction loans for over 10 years. It's up in Flagstaff. He's coming through the winter season. There were some changes with the buyer, so he asked for 60 days. We'll probably be paid off in that in the next 30 days. So, but we'll always work with the borrower because we're not loan to own. I really don't want to run around and do foreclosures and all the rest of that stuff. I mean, I make a loan here to get paid. And also, if we do have to chase it down, okay, then let's look at
Kind of a
the.
novel idea.
It's weird, huh? But truly, and you were nodding at this, but foreclosures are a hassle. You can get through the foreclosure and you can get all your money back, cover all your legal fees, get your default rate, get your late charges. We just got one. We got all our late charges. We got our 29% default rate. At the end of the day, we got a great return on that, and so did our investor. But it's a big sidebar of energy. It's a big hassle. Yes, sir.
Just wondering, so your initial, when the borrower comes in, your initial loan is at what loan to value?
We do, and that's a great question too. We do a minimum of 20% down on cost, always looking for at least a 30% equity. So 80% LTC,
Right.
70% LTV. And that's what we're looking for as a minimum. And again, I just had this gentleman, 770 credit scores, works for the newspaper, put 40% down. you know, it's not uncommon for some of our people to buy $200,000 homes, put 100 down. Because again, they don't, if they're gonna pay us 16 or 18%, they wanna keep that to a minimum. But those are good loans for us, obviously, so.
Any foreign investors?
On the note buyers, you mean? Or borrowers?
Buying properties or buying notes?
We do the loans for foreign nationals.
Okay.
You know, at that point in time, I'm taking a closer look at the collateral, because a foreign national, I was in the A-paper lending for 21 years, and then I joined Rick back end of 2010, so I've been brokering hard money since '94. I originally brokered out $11 million to put in Legend Trails up in North Scottsdale, and then I've done a lot of construction lending and all the rest of that stuff. But, you know, on the A-paper side, I just totally lost my train of thought. What was the question?
Foreign national.
Foreign national. You know, we did a lot of A-paper foreign national, thank you for that. Did a lot of A-paper foreign national loans, but what happened when the market crapped is they could all go home, and it was no big deal. So now you'll find hard money lenders like myself that'll do foreign nationals no problem as a loan, but what we're doing is we're looking more closely at the collateral. Because at the end of the day, the foreign national could basically get on the plane and go home. So, but yes, we'll do them.
You mentioned the 770 credit score guy as an example a couple times.
Yeah.
Curious, what makes him go hard money route? Was there something about the property that where?
Great question. He bought it at auction.
Okay.
And that's where Titan originally started, and I don't know if I got through this introduction before you were here or not, but, okay. So we originally started to help provide funding for investors buying at auction with our sister company, Infoclosure. So, and we still have bidders every single day that are down there, you know, yes, they're not picking them up as frequently and the margins are a little bit tighter, but he got one at auction.
So he can get a loan from a conventional lender at 3 or 4% if it was a primary residence, but he needed it quick.
Yes.
Auction,
Yeah.
fund immediately.
And he's a client of Infoclosure, and what our normal Infoclosure clients do that we train them to do is reach out to me ahead of time, let me know the property address, what your maximum bid is, how much you want to put down, verify that we have funds available, because we might be down to our reserves one day, we might be sitting on $1 million another day. It just depends on where the cycles are for, you know, with payoffs and all the rest of that stuff. Or all of a sudden I get 6 note buyers come in and they drop $800,000 and take a bunch of notes, so I've got cash to lend out. So we ask them to just give us that profile and we make sure, yes, we can back you up, and then boom, he's successful. Great, so then the next day he's in here, we've got all of his loan documents together. We use Calyx Point, which is a traditional loan processing system, so we do a complete loan application on the borrower, all the appropriate, you know, safe harbor disclosures and TILs and all the rest of that stuff. And then they come in here, we sign everything, they bring in the balance of their funds, we get the cashier's check down to the trustee. And yeah, it's a short-term bridge loan, and he knows what his strategy is. He's going to test the market and see if he can sell it, in which case we might get paid off sooner. If he's not getting his price, then he's going to put a tenant in there and he'll convert it to a conventional loan and he'll easily qualify. But to give himself some latitude, I always ask him 6-month, 12-month, 24-month, and we have different pricing structures and things. He wanted a 12-month. So who knows? I have a feeling it's a 12-month that'll pay off in 4, but it's a 12-month and he might go to 10 or 11. But it's a nice property, I'm not that worried about it.
Does the title company issue a W-4 at the end of the year and report all the income to the IRS?
1099.
Good question, David, and thank you. Yes, when everything goes to security title, so for our note buyers, let's just say if you all buy a note today, we get all that set up and the note goes down to security title for account servicing. As soon as it's set up there, which is within 24 hours, then you actually get your own account number and you can log in and see the status of that account or that loan. So by the 3rd of the month, you know, is the payment received? And once the payment comes in, security title is another thing I like, is it goes out to the investors within 24 hours. So it's not like a payment comes in on the 2nd, you don't see it till the 8th. It comes in on the 2nd, checks go out on the 3rd. And you can monitor all that online, and then yes, they issue you the, it's 1099.
1099.
Yeah,
Yeah.
miscellaneous income.
Yeah, but they do issue that, and we do as well, if there's any transitional period that the note is here. Okay, but that's a good question.
Is there a one-to-one relationship between a note and a particular property? Or can there be multiple notes that add up to a property type of thing?
And that's a good question, and if I understand it correctly, we have, the way we're set up is one buyer to one note.
Okay.
Is that what you're asking? And we only have one note to one property.
Okay, that's, so basically, if I buy a note, that note is the one and only note tied to that property that he got the loan, he got a loan for that property, and I buy his note basically, and that's the only note that exists on that.
Great question, and yes, one note one property.
So there, you don't need
First-
basically notes like $10,000 notes that are 10 of them tied to a property. Okay.
Because then when that one goes south, and you're nodding your head, that
Well,
is a
yeah.
huge nightmare.
You got
Uh,
10
Right,
people that are
you
pissed
either
off.
extend it or
Yeah.
you refinance
Well,
it,
no,
but
I'm
you
just
keep it
trying to,
clean.
yeah.
No, it's great question, but I even go a different way and say, one legal to one note to one borrower. Well, we'll do multiple borrowers. We won't do multiple note investors, and there's a reason for that, and that is, if I put you and you on a note together, I can do that, but now it's a security. And then in addition to all those other
now
licensing
you
things
got
we have to adhere to,
security
now I have to have securities licenses and all the rest of that stuff. It's a hassle. I don't want to do it. I'd rather say, here's my list of notes. We have $2.5 million of notes available today. Find one that fits for you. We have some that are maturing in 3 months, some that's maturing in 6 months, some in 8 months, some in 22 months. So, but I can't put both of you on a note because it's a security, and I'm not going to do one note on multiple properties because that's a hassle.
You said
I think that's the better way to
50,000 was the low end of the note. What's the high end?
305 right now, I think. But a pretty predominant, we have a lot of stuff that's in that 100 to 150 range.
And
So-
those first position notes, right?
All first position.
What's stopping the client from getting a second note on the house?
Nothing.
Nothing?
We have some, I have a couple right now that just bought a really cool old historic home down in Tucson. And as is, we valued it probably $250. They got it for $210. They put 20% down, so I think we're about $168 on that. And it's a cool old historic home on a great piece of property. And they're gonna put about $200,000 into rehabbing it, completely restoring it, of which we're gonna lend them about $100. But the value upon completion will be about $450, probably conservatively. And again, I can already tell by the work they're doing, it's beautiful. But when we do a second like that, we handle it like a construction loan. So, and we only do the second if we have the first.
Yeah.
I'm not gonna do a second behind your first and, stuff like that. I'm only doing a second if and I'm not doing a cash out second. I'm not doing a let's go to Hawaii second. I'm only doing a second if it's something that you're gonna make the house better with, and then we treat it like a construction loan. So we've got the 168, I get all your contractor agreements, I get all your budgets, I get everything. We do inspections along the way. If it's Flagstaff or Tucson, I get an appraiser that'll go by and do photos and inspections for us based on the draws, and then we do draws based on work completed. So we monitor it very closely. But, that's a project I'm enjoying being part of. It's gonna be fun to see how this thing,
But can they get a second from somebody else, or?
they can get a second from somebody else,
Two.
as long as it doesn't, do anything that interferes with my first.
Right.
Yeah, I don't care if they go get a second from you to do all their rehab. That's fine with me.
That's fine, okay.
Yeah. So, good questions. And some of this we're already having some discussion on, so I won't bore you too much, but why do we sell our notes? Well, why did I make the conversion 3 years ago from A-paper to subprime? Because I saw all the changes take place. I was a high production loan officer with A-paper banks, and when I saw, and my clients were not subprime, my clients were good borrowers, business owners, athletes, A-paper borrowers. When I saw what was happening to the A-paper borrower, I thought, that's going to be I don't know that I can wear that hat anymore. And I also thought, you know what, there's going to be a bigger demand for bridge money because the banks are tighter. You can't get a credit line on your home to go do flips, right? You can't get quick short-term financing. Investor financing is very difficult. Oh, was it listed within the last 6 months? What did it last trade hands for? All the rest of that stuff. So why do we sell our notes? Because, as I mentioned before, we have a demand here that exceeds our available capital. So it doesn't mean we're broke. It means we have X amount of capital, but we have more demand here because of who we are and our presence. I've got a stack of loans right now on my desk that, if I had an extra $2 million right now, I could fund them probably in the next few weeks. But, if I can't fund them, I've got good relationships with fellow hard money lenders, and we cover each other from time to time. So I'll always work with a client to help them get a loan placed and that kind of thing. But basically, I think because of the market, because of what's happened in the mortgage industry, because of what's happening in the banking environment, and because there's a real active component out there for the investor, right? Even though the fix and flip stuff is maybe changing a little bit, there's still an active real estate investor out there who needs to borrow bridge money because they don't have the credit lines on their bank and they can't get bank loans to do what they want to do. Or if they want a bank loan, it's going to take 60 days to get it. So increasing demand for private equity loans and adding other markets. In other words, we're here, we're in Las Vegas, and we're opening up in California. And InfoClosure's already in California in the LA market. So, how our notes are created. There's a couple slides here that I'm kind of messed up on my. My partner did this one, and I'm not sure I have this one down, but let me try to, I think most of you get this, but there's a borrower, okay? They put 20% down, which creates the note. Titan has, at the time we put this slide together, we might have had 18 available notes, okay? Then there's a note buyer, any one of yourselves that picks up that note, and then there's all the corresponding documents and everything else that goes to you as the note buyer and servicing down to security title. That replenishes the funds back to Titan to go ahead and be able to make loans to the borrower and recycle all that. So, does that make sense? I think everybody kind of gets that. We were talking about equity and appreciation, but you had a little different angle. This gentleman was saying, what about inflation? And but the component you meant is, if I buy a note for $100,000, how am I benefiting from inflation on that? Well, in how we sell notes, you're not benefiting from inflation on that. How you are benefiting from inflation is if an investor is buying a note today or buying a property for $100,000 and putting 20% down on cost, right? And then they go out and over time they're rehabbing the property, and then what else is happening? Inflation is happening, so this real estate market that we're in is also, in addition to the improvements you're making to the property over time, the market's also naturally appreciating. So I think we were having two different discussions about it, but what I liked about it is, if you're buying this note for 80 and you're on a 6-month term, okay, the investor or the borrower is fixing up the property, which is increasing the value, which is how that slide was originally structured. But given inflation and given what's happened in the real estate market, all that's happening is your security position is becoming stronger and stronger, right? If you have to default, if you have an $80,000 note against a $115,000 property, you just want to make sure that that $115,000 property doesn't become worth $90 and threaten you getting your capital back, right? But when we're in an appreciating market, that $115,000 home with inflation is becoming $125,000, $130,000, $140,000, which is further securing your $80,000 loan on that property, which is what I'm concerned about. I'm concerned about the security of the $80,000. Make sense? Or the other side of it was, just take the 100 and go buy real estate and let that appreciate, right? Sophisticated, over 97% of investors don't have a checklist for investment decisions, okay? So that goes back to you guys, although most everybody here I think knows why you're here and with the cash and investments in the notes. Successful investors take one critical step to make sure investments they are considering meet their needs. They look at 6 components, okay. See if I can get that, hit the right one. Safety, security, long-term relationship with a note producer like ourselves, positive cash flow, favorable tax treatment, and above average returns. Favorable tax treatment, a lot of people don't know this, but you can, if you're sitting on retirement funds, you can do self-directed IRA purchases of notes. Do you know that? Everybody know that? There's 2 firms that we work with locally. They do a great job. Our note packages have already been approved. So if somebody's sitting on IRAs or some kind of self-directed retirement, you can work with those firms to direct and buy the notes. So that's a big deal because a lot of people are sitting on IRAs. I don't have one. But I'm talking to people that are going, it's the same today as it was 10 years ago, or it's the same today as it was 5 years ago, right? Safety. You buy a note. The note is your income. We were having that discussion earlier. The note's your income. You're secured by the deed of trust, which is a first position deed of trust, which is the lien against that real property. So what's cool about that? You can drive by it, right? Drive by it, look at it, kick the dirt, smell it, wait for the guy to default. Do all those things, right? But the safety is you're not buying a stock. I was talking about the stock market earlier, and the stock market does great for a lot of people. I think you have to be in that space, you have to be in that game if you're going to make it in that game. But a stock, you can still buy a stock at 20 bucks a share, and it can go to 10 bucks a share or 5 bucks a share. What you have to ask yourself is, if you're going to buy a $100,000 note on a $150,000 property, how safe is your $100,000? Well, 8 years ago, might not have been very safe, because that $150,000 property, we all saw them go down to 70, right? So your 100 got a $30,000 haircut. Everybody went through that, and there isn't a note originator on the planet that can't avoid that unless you had a better equity position, okay? But you look at it today, and everybody can realistically look at it today and say, okay, the real estate market is appreciating, right? So my $80,000 note on that $100,000 purchase that's already appreciated to 115 is going to appreciate to 125, is appreciate to 130. So how much risk is your $80,000 at? Should be less and less over the next 6 months, 12 months, 24 months, right? So, but let's take a worst case scenario. Got a $100,000 note on a $150,000 property. It takes a hit. Let's just say it goes back to you've got a $100,000 note on a $150,000 property that's now worth $100,000, and you've got to get rid of it. You've got selling expenses, taxes, title fees, everything else. You're going to end up with what? 90? Okay, you might have got some income along the way, but you're getting 90 back on your 100. You didn't lose your 100, and that's what I like about the real estate side of it. You didn't lose your 100. You didn't have a stock that went from 20 to 5 or 20 to 2. You didn't lose it, but you might have taken a haircut. That's a worst case scenario. I think we're a few years away from seeing that. And as long as our notes are properly structured, you know, I think our track record will continue to be pretty good. So safety, security, the positive cash flow. Again, why do you buy our note? It was a discussion we had earlier. Our notes generate income paid monthly. Our notes are mortgages. We make the loan. We make it today, which is June 6th. So we fund it today. Just like a traditional mortgage, the borrower will pay 24 days interest for the balance of June. You get your portion of that. We get our portion of that, right? And then the first payment is not July 1. The first payment then is August 1 for July interest, because all mortgage payments are in arrears. So it functions just like that. So we fund it today. There's 26 days, 24 days interest. I might stumble up here a little bit. 24 days interest. Okay, you buy the note today, we fund it today, you buy it today, you get 24 days, we get 24 days, and we both see our next payment come in on August 1 for July interest.
These are fully indexed and full payments, right?
Full payments.
PITIs and fully indexed.
No, good question. Our short-term loans are all interest only.
Interest only, okay.
All interest only. Yes, no, another good question. No prepayment penalty, 14, 16, 18%. Short-term bridge loans, all interest only.
Interest only, not for you.
Now we do have some borrowers that just like to send in that extra 100 or send in that extra 500, or we had one guy that I think started with a $25,000 note and it's down to 13 now, and we've renewed it twice for him on 6-month terms. He's had issues getting people in and out of the house or selling it, and I don't know, but he keeps paying it down. He pays on time, and the house is in good shape. So I'm not sure what the story is, but yes, interest only.
What about fees, appraisal, title search?
We do all that up front. All that's up front. You come in to borrow, so we put together a loan package. Okay, you're buying this $100,000 house for $100,000, and you're going to put 20% down, so we have an $80,000 loan. We have a title insurance policy, so we're title insured, first lien position. We make sure hazard insurance is in place, and Titan and/or assigns. You know, you're borrowing, you're buying the note, so Titan and/or assigns is listed on the hazard insurance policy. We do a 104 title endorsement, which means that Titan is insured in first lien position on that title policy, and the endorsement just means Titan and/or assigns is protected there. We do an appraisal or a BPO, or through our real estate company, I'll have our broker pull comps. I'll always do an analysis of one or two or sometimes all three if I feel that there's an issue there. But all those, you're borrowing, but you're paying the appraisal fee or the BPO fee, you're paying the title insurance, you're paying the hazard insurance. We've got a processing and underwriting fee, we've got the inspection fees that go along with that, you're paying all that.
Do you get any pass-through profit from?
For the note buyer?
Yeah, or for yourself with the appraisal and those different?
No, we don't. You know, it's there used to be a time you could mark that stuff up. I don't think you can mark it up at all now. And quite frankly, it's just a hassle to do it. You know, you mark it up for an extra $20 or $50 or whatever. So we have our underwriting and processing fees, and then there are loans that we charge points on. So that covers the administrative side of our business. Everything else it goes directly to that service provider, whether it's the BPO or the appraiser, title insurance, all that stuff. So we're not marking anything up in there.
So the way it's set up, the check I get every month is split between me and your company, and it comes from Security Title, not you.
Correct.
Okay.
Oh, good question. So I'll do the scenario again, because I want to be real clear, and don't be afraid to overly clarify that. So you've borrowed that money from me now, okay? We've issued the loan, we've gone through that process. Now, I was going to point to you, but now you're buying the note. So you've bought that note, and we do the assignment to the deed of trust, so we put you in first lien position. We do an endorsement to the note, which breaks down the note, which says he borrowed it at 18% for 6 months. Let's just use that example. Okay, we funded it. If nothing else happens, it stays right here. We service it here. You make your payments to us and everything else, but now you want the note. So you come up, write the check for $80,000, takes out our position. We assign the lien position to you. There's all these endorsements and these other things, and we've got a instruction sheet and everything else for Security Title. All that gets filled out. You sign it, I sign it. All that goes down to Security Title. You're notified that your payments no longer come here. They now go down to Security Title on Central, okay? So you start sending your payments down there the first of the month, okay? So his payment gets to Security Title. Security Title looks at it and goes, okay, here's a $1,000 payment. I send $600 to you. I send $400 to Titan minus the servicing fees, which is $1,875. Okay. So in other words, with our pool of in-house investors, we pay our investors anywhere from 9 to 11% right now. Okay. So we're already working on those margins. When we sell the note, you're just taking that price. We're still in that income with you. So we're not selling you the note and saying, hey, good luck, hope it works out. We're selling you the note, but we're doing an endorsement to the note, and we're continuing to collect the income with you. You're getting the first 10.5 net, and we're getting, whether it's a 14 or 16 or 18, we're getting that spread minus the servicing fees.
So you share the risk.
And they also have skin in the game.
Oh, yeah, yeah.
So that
I got that.
they're not going to issue a bad loan because
Yeah,
they don't get
we're
that.
as dependent as you are to make sure that that income comes in every month, okay? And the good news for you is if it isn't, I'm usually on the phone with the borrower before you are. But I can tell you this, and this is pretty good, but I think about May 10th or May 12th, we had maybe 36 loans being serviced, okay? May 10th, May 12th, we had 2 borrowers that hadn't paid yet. The funny thing is the 2 borrowers that hadn't paid are 2 borrowers that have borrowed a lot of loans from us. So they were regulars. So, I call one guy up, and as quickly as he answers the phone, Adam, I'm on my way to the bank right now. I'm on my way to the bank right now. And he was. Payment was in there by the end of the day. The other guy had already given me a heads up a week earlier, so he was waiting for a tax refund check, and could he pay me when that came in because he's putting his other dollars into the rehab. And it showed up a few days later. So, by the 10th of May, everybody was paid up in full, plus those 2 guys. So by May 15th, we had everybody in. You were going to ask something?
Yeah, using that same scenario, if he's the borrower, he now owns the note. If he decides, let's say his monthly payment, what he owes in interest, it's interest only, right?
Correct.
Say he owes $1,000. He decides instead to pay $3,000. He wants to pay it down a little bit.
Correct.
So does that extra $2,000 then all go to him to reduce his principal, or how does that spread out?
Oh, yes, and a good question. So, but first thing we're going to do is say, what did you want to do with that? And he's probably going to say, yeah, $1,000 to my payment, $2,000 to principal reduction. So that's exactly correct. Then the $2,000 will go to him to reduce his, what were we saying, 80? So the 80 now becomes 78. We do an adjusted schedule to Security Title, send it over. Then the interest coming in also gets adjusted to coming in on 78 instead of coming in on 80.
Right.
Yes, and Security Title processes, that's a great question. Thanks for that.
Okay, one other question. So
Uh-huh.
at the point where a note becomes a foreclosure and the property needs to be disposed of, and let's say there is money to be made when it's sold off again or something, does all that revenue come to the note holder or to the servicer? How is that?
And that's a good question, and let me clarify on that too. We can't profit through foreclosure. We can get paid off through foreclosure. but we can't profit through foreclosure. So let me give you an example. And that's a great question. I'll tell you how you can profit, but we can't profit through foreclosure. One of the things I haven't touched on is our notes have a 10% late charge on the 6th day of the month. So you have 5 days to pay. On the 6th day, it's a 10% late charge. What that means is if it's an $800 payment, it's now $80 that you owe in addition to that, okay? On the 36th day, we have a default rate, which means the overall interest rate, whether you were at 14 or 16 or 18, we have a default interest rate of 29%.
Yeah.
So here's what happens on a foreclosure, and here's where we make the money.
From that point forward, it becomes a
From 36 days till it goes all the way through foreclosure, the rate on that loan is 29%. And that is in our, good question, that is in our note that way. So 36 days you go to,
For the fees for the different late days and then the increase in the interest, how does the note holder, you sold the note to somebody else, do they participate in that additional revenue?
and I was just getting to that, and yes, we split it equally. So even though you might be at 10.5 and we might be at 4.5 or 7.5, the late charges are split equally. So for an $80 late charge, you get he gets 40, we get 40. When it goes to, if let's just say it's a 16% note, and now you're in default, so that 16% is escalated to 29, so that's 13%, we split. Okay? So you don't profit through foreclosure, but I told you those parts because let's take that loan that's defaulting. It's defaulting. So the first thing you have is you have the 10% late charge. Then it goes to 36 days. Now you have the interest rate escalates to 29%. Now you go ahead and we get the trustee and we file for foreclosure. So just for easy math in my head, I'm going to say, here's a $100,000 loan. It's going to take about $2,000 in legal fees to get it foreclosed on, right? And then you've got 90 to 120 days that we're not getting paid. And let's say it's a 16% loan, so it's 16% plus the 10% late charge plus the escalation on the 36th day to 29%. So you add all that up. By the time it goes to foreclosure, if the house is worth $150, we can't bid it up and profit, but we get our 100 plus the legal fees plus all the interest, late charges, and the default. Add all that up, and if it adds up to 112, even if the house is worth 150, we can only get that 112 back. So then you get your 100 back, the attorney gets paid the 2,000, the trustee for the foreclosure, and then you get your interest back, and we split all the late charges and the default interest.
If there's money left, what happens?
Good question, and so let's say our max is 112, and that's all we can get. We can't profit on it, and the house goes for 120. That extra 8 has to go to the original borrower.
Question, now I hold a note on this property being foreclosed.
I like this one we have going.
So I now hold a note to this property that's been foreclosed. Can I go and talk to the borrower and try to negotiate a deed in lieu of?
You absolutely can. We have a provision for that in our note as well.
Because that's how you can end up with the property, answering the question. Now I end up with the property, and now I don't have to give, now the property's mine, physically.
Complete, of our 5 defaults, 3 were deed in lieu, 2 were foreclosures.
Okay.
So the answer is yes, you can do that. And we had, and real quick, we had one gentleman where he and his son were involved in all these flips. They were on like their 6th loan with us, just like clockwork, doing a great job. The son came from the utility industry and got some great job offer to move back up to Oregon or something. So moved back up to Oregon, adios dad, and they were on their last property. But it ended up being kind of a big rehab down in Central Phoenix. And he contacted Rick, my partner here, and said, I'm in over my head, here you go. Signed it over, I can't do it, here's the keys, here's everything else. It was just more than what he could take on. We went in there, finished it off, listed it, sold for more than we were asking for it, and we were out of it. So there's a way you can profit.
Right.
The other way you can profit is, let's say you go through that foreclosure process and you've bid it up to 112 and nobody buys it. A pretty slim chance in Maricopa County today that that's going to happen, but let's say you do that, nobody buys it, ends up back in your lap. Well, we settle up, and then you can take it and go do what you want with it.
I don't think you can go and bid it. You cannot bid.
No, we just get it back.
No, but you said that you go and bid it up. You cannot go to the foreclosure and bid on the property.
If I said it that way, I didn't.
Okay,
thank you
if you
for
have an
correcting
interest
me.
on the property, you cannot go and bid at the foreclosure auction.
No, you just get it back. Yeah, thank you for that correction.
So how about the notes? Are you handling the notes that you take as, what am I trying to ask?
Happens to me all the time.
I don't know how to put it, but the notes that you are, the properties that you are lending on that are not the subject property, so the ones that, does that make sense?
Another property is your goal.
Like the burnout that you were talking about, you lent on another property.
Oh, but I have
as-
nothing to
as
do with the
security.
burnout.
Yeah, the property.
Right.
I have nothing to do with the burnout.
I understand, so
Yeah.
those notes you're also selling, which,
The
Our
cash out
property.
refinance I did, yeah, that one got picked up right away. You mean where I didn't do the burnout property, but I
Right.
took
did
his other
the other
nice.
one, yeah, which is probably.
Yeah, it was like a
much
$60,000
nicer.
loan on a $140,000,
Yeah.
all
Loan to
beautifully
value, yeah.
redone triplex down in the Capital District,
Those
yeah.
are nice.
Yeah, that one hit our note sheet and went boom, gone.
Sure.
Nice property, nice, you know, all
course.
recently redone. Yes, sir.
When you're doing the settle up, you said that, you know, like your company Titan would get its part and then the note holder would get it, the rest of it. What additional percentage or fees, like this $100,000 property that you've got an $80,000 note on, say like that goes to foreclosure sale, it's not picked up, so then the note holder gets the property, what additional fees and monies would he need to provide to you to close that all out, just be sold?
To foreclose on a property is gonna take about $2,000. You know, at that point in time, we'll be having discussion and just, you know, do you wanna handle it, do you want us to handle it? You know, we'll take it cradle to grave all the way through, you know, do you want us to handle those fees and we'll settle up later? You know, if it goes through auction, if it doesn't get picked up at auction and it comes back, then we can sit down and decide how we wanna handle this thing. Because again, we're still looking for our income out of there with you. And now we've got legal fees for the foreclosure process, so we've gotta just sit down and address all that and see how to get out of it.
On the person that you lend the money to, you lend it at 18%, I buy the note, 10% net, you said?
10.5.
10.5 net.
Right.
What about taxes and insurance?
Well, good question, and again, because our notes are short-term, 6, 12, or 24 months, we always make sure they're paid up. So we just had, the gentleman who just put 40% down, he picked that property up at auction, but there were 2 years' taxes due, so we had all the taxes paid up.
But who pays for it?
The borrower.
The borrower, okay.
Yep, the borrower. So he came in to buy that property and borrow the funds from us, the 60%. But he came in with the balance of his 40% down, and his closing costs, and his taxes, and his hazard insurance, and the title insurance policy, and he wrote checks for all that, and we did all that here. But we just make sure the taxes are paid up, because taxes that are delinquent aren't really a problem for us until 2-3 years down. Well, we're 6, 12, 24 months. So if we restructure ourselves and start doing 5 or 10-year loans, then we'll get into impounding. And we can do all that through security title, but I don't have a need to impound right now on 6 and 12 and 24 months.
So they're just paid up front to begin with.
So you don't impound the insurance and stuff due to the short term of the loan?
But the insurance has to be paid for the term of our loan.
Okay.
Yep. So we do a 6-month loan, and the dollar doesn't leave here until, so if you're buying that note, you're gonna see if it's a 6-month note due in November, you're gonna see a hazard insurance policy there that's due in November. Okay, and because we're listed as the additional,
Insured.
person on there, we get notifications. We monitor that
What about bankruptcy?
as it pertains to,
To the borrower files for bankruptcy and doesn't pay the note.
doesn't pay the note? Well, then he's in bankruptcy, but the note pertains to foreclosure. So if he's going bankrupt, then he's defaulting on the loan. We go ahead and go through the foreclosure process. If he's defaulting on the loan, the bankruptcy might put a 30-day stay on, stopping us from going through foreclosure. So instead of getting through in 120 days, we might get through in 150 days. But bankruptcy won't affect our ability to foreclose on a property. Might delay it 30 days, rarely more than that, but good question, yeah.
If a borrower comes to you and says, I need extra time, do you make that decision, or do you make it with the person who bought the note?
If there's a note buyer in place, and that's a good question too, David, I would usually reach out to the note buyer and I'd say, David just contacted me and,
But contractually, you don't have to do that. It's not written in the documents.
No,
Okay.
no, it isn't. Contractually, the borrower is late on the 6th day no matter what.
Right.
And if he wants to call up and make arrangements to catch up over the next 30 days, there's still late charges. And if he goes past 36 days, there's still a default rate of 29%. Those don't change. But my objective, the hat that I wear every single day is not only to try to make good loans, but the other part of the hat I make is to make sure that if there's a situation with the borrower, that we're working with the borrower to make sure we get paid. Right up to the point where we make the decision, you know what, we're done screwing around with the guy, we gotta foreclose. And if we make that decision, we make that decision together.
What's the time period to make that decision? 30 days, 60 days?
Well, 36 days is the default according to our note and deed of trust. So at 36 days, we go into default.
I like that.
I don't want to screw around.
Well, I had a guy tell me once when I told him my terms that was illegal to do that on a loan. No, it's not. It's my money. It's my rules.
I think you have to.
People are spoiled with the other banks.
Oh, yeah.
They
Arizona
sit
does
for a
have
year.
some laws that
Well,
guard that.
My lawyer blessed it.
Keep in mind too that there's a difference between primary residence and investment property. I think on a primary residence, you gotta give them 90 days. And then at 90 days, you go to foreclosure, which takes another 90 days.
Actually, it takes, the notice of trustee goes through 2 3-month periods. First notice, second notice, final notice.
I haven't had one take that long.
But
you have.
Believe me.
So,
Initial notice, second notice 30 days later,
But that's
final notice.
that's why what you want to have the option that you're talking about. You want to have the deed in lieu option.
Yeah.
Go out there
that's-
and just say, look,
Yeah.
let's get this done, because that's the other thing too, is our notes have personal guarantees. So there's some
At a
teeth
minimum,
there.
you're looking at a 6-month process to foreclose for practical purposes. If you move as fast as the law allows you to do that.
Our last one we did was probably all in maybe 150 days. Yeah, but okay. Yes, sir.
Oh, he had something else
Oh.
before me.
I forgot.
It's the.
What about the borrower buys it as an investment property, then moves in? Is that considered?
Well, we just,
Was that
by the time the note matures, we need to address it that way. We are able to do a primary residence loan, but the documentation we do just changes completely. Okay, all
Still hard
the
money loan.
disclosures, yeah, we can do a hard money primary residence loan, but the pricing structure changes, the term changes. On a primary residence loan, you have to have a minimum term of 7 years. You know, can't do interest only on primary residence. Because interest only is considered a balloon. Can't charge you 16 or 18% and can't balloon you on a primary residence. So I can do our hard money loans on primary residences, and we have note buyers that specifically like those, but you're looking at a minimum term of 7 years, okay, and you have to amortize it 10 or 15 years. You can't call it due before 7, and you're looking at rates that are going to probably, you know, maybe 10.99, probably 9.99. So a note buyer's going to get 7 or 8%. A little different deal. I've got some of my friendly competitors I've known for over 20 years. We share ideas all the time. I've got one guy who just plays in that space, but he
What's
does
the down payment then?
35%.
They still look at credit and all that.
Oh yeah, yeah. It still fills a niche that's alternative to conventional Fannie Freddie.
There's a lot of people in foreclosure and short sale that they have cash, but
Tons of it. People that have been through the adjustments to the market, they got beat up, but they've reestablished their income, their cash, they're working on their credit, but maybe they're 2 years out of bankruptcy. I had a regular one of our investor borrowers, we've done 3-4 loans for him, and now he's like, I want to do this as my primary residence. I'm a year and a half out of my bankruptcy. I know I need a couple, 2-3 more years to finish repairing my credit and doing all the rest of this stuff. But we can do that, but it's got to be more money down. It's got to be a minimum 7-year payout. It's just a different deal. Right now, there's so much demand for our investor product that I like running in that space. Candidly, if I do a 6-month flip for somebody and he ends up moving in there and it comes to the end of 6 months and you own the note, I'm going to probably send them over to one of my hard money buddies that does a long-term primary residence. We'll get paid off and we'll go find another one to do, right?
In an investor situation, with an 80% loan to value on a single family, what kind of DTI are you looking for?
I'm looking for the ability to pay.
Okay.
Okay. One of the things I like about being more of a traditional underwriter, if you will, hard money lender, bridge lender like we are, you know, I could go back 10 years ago, and when Johnny and I were writing A-paper loans, if somebody had $1 million in the bank and they made $50,000 a year, well, you take the $50,000 a year, but the $1 million, you could also take it over 10 years and add that to their income. So if somebody comes to me like our typical borrower, and they're a self-employed investor that doesn't show much on their tax return, but they've got a couple $100,000 in the bank, and they put 30% down or 40% down, and their credit history is good, except maybe they had a short sale or a foreclosure, or they might have gone through a bankruptcy, yeah, they're probably a pretty good borrower, right? So it's not a good question, but it's more, I'm looking more for the ability to pay than just a DTI hit. Now, if I'm doing the primary residence loan, got a totally DTI, income qualified, you can be a year out of a bankruptcy, but I still have to fully, you know, process it and underwrite it more like a conventional loan.
Right.
Then there's maximum pricing points in there and everything. Great questions today, guys. Yes, sir.
So now, I'm looking at buying a note,
Uh-huh.
okay, and you give me a list of notes that are available.
Mhm.
Okay, does that list contains the properties, the address of the property?
Oh, yeah.
Because to be honest with you, I want to do my own evaluation
You
of the
should.
property. I could care less about what some appraiser decided was valued at. I want to go and get my own.
I
value
write the
opinion.
loans the same way you do. But yeah, when you buy our notes, you're not just buying it on a hope and a prayer. You get my list, you get the address, you get a look through the borrower file that we've put together. So you can see the BPO that we have, or you see the comps that we have. You can look at the borrower application. We do the credit. So you can come in here, I can either scan it to you to review, which is done in confidence, by the way, because these borrowers are
Sure,
confidential.
no, I understand
right?
the confidentiality.
But before
of it.
you write a check, you can drive by the property, you can determine your own value, you can look at the borrower file, you can look at the credit. By the way, you guys have heard me say I pull credit, but you haven't asked me if you're just out of bankruptcy or you're just out of foreclosure, what am I looking for on credit? Okay? There is something I look for on credit. So every borrower file has a credit report in it. Here's what I'm looking for. I'm looking for a train wreck. Okay? If I pull a credit report and the guy's got tax liens up the wazoo, judgments up the wazoo, and he's in the middle of a Chapter 13 bankruptcy, I'm going to probably steer away from that borrower, because those are things that could challenge my lien position. Maybe, maybe not, but it's questionable. If there's a bunch of tax liens out there, and if there's a Chapter 13 that somebody's in the middle of, and there's all this stuff on his credit report, I don't want to get involved with that borrower. I just don't. I don't care if they put 50% down on the home, I just don't want to be involved. So we have credit scores here that range from 500 to 800. They really do. But what I'm looking for on a credit report is stuff on that borrower. First of all, I want to make sure it's really the borrower. And second of all, is there stuff on that credit report that could potentially challenge us? If there is, I don't want to do that. But yeah, the list that you get is going to have the address. It's going to have how we valued it. It's going to show the maturity. Do you mind asking Ashley to print out maybe a half dozen copies of our current notes for sale?
Sure.
Thanks, Jen. But it'll have it has our loan number, has the loan amount, what we valued it at, what it matures at. What else did it have on there? So yeah, you can look at that list and do your own due diligence. And that's what a lot of our note buyers do. We have a couple that's out in Surprise. Give us every first look you have out in Surprise. We live out here, we know the area, one's a real estate agent, husband, wife, and they looked at 3 notes we had in Surprise. They made a decision to pass on one note because they didn't like the floor plan of the house. And out of the 3, that was the first one that sold. But they took 2 others and they were happy, and it was good. They did their own due diligence on the thing. So yeah, absolutely.
She's bringing them in.
Thanks.
And could you explain what a wazoo is? Is that a technical term?
It's when I was a kid and we went to camp, it was something that we used to blow around the campfire.
That's a kazoo.
Oh,
I'm
confusing.
sorry, guys. A little
Folks,
quiet
this
in here.
is Johnny Walker, who runs Infoclosure here, and we've known each other for too long, so that's how that happens. I'll try to zip through some of this. I like this discussion better because we're getting right to what you guys are wondering about. We talked about the safety component. I have to throw this in there. It may not be suitable for all investors. What are the risks? Let's just talk about it again. Loss of principal. That's what you've got to evaluate when you look at the note and the property and do your own due diligence. What's the other risk? Loss of income. Loss of income for a period of time if you have to foreclose until you go through the foreclosure process and collect all your interest, your late charges, and your default, and move on. So, for me, I really don't want to foreclose. We've been through it. it's just a hassle. It takes a lot of energy away from the productive part of your business. So we really do try to make the loans to get paid and get paid off and go make more. And that's why 325 loans, 5 defaults. 3 by deed in lieu, 2 by foreclosure.
What attorneys did you use, or did you use attorneys for your foreclosures?
We have our business attorney right now, a gentleman by the name of Michael Tafoya, who I've worked with for many, many years. We've made him our trustee. He specializes in real estate and bankruptcy. So we've just made him our trustee, and so he handholds everything, which isn't much. It's not like we're not giving him a Bosco building yet or anything like that. But prior to Michael, we had Bosco. Borrower qualifications and requirements. So we had some of this discussion. Borrowers are screened using traditional loan application process. That's what I brought to the table, 24 years in that space. Like I say, we use Calyx Point, we use a traditional loan processing system, full disclosures, et cetera, et cetera. Minimum 20% down on cost, but always looking for at least a 30% equity position, okay? Again, the good news with a lot of our investors is they're short-term borrowers, and they'll buy a property with 20% down on cost, or like the other gentleman, the 770 credit score, 40% down, but then they use their own cash out of pocket to do their rehab, which in my opinion just further enhances our equity position, right? Property valuations, we do property valuations on everything based on, if it's an auction purchase, you don't have time for an appraisal or a BPO, so we do a CMA, comparative market analysis. I have our broker pull comps for me, sold comps only within the area. And then I do my analysis. Nobody tells me, you know, I like what you said because I don't care what an appraiser says. I don't care what a BPO person says or anything else. What I care about is I want to see the report and then I want to see the comps myself. Because that's what you know as well as I do. That's what, thank you, John. So I'll give you guys a list when we finish up here. But we do CMAs, comparative market analysis. AVM is something that we have access to. We're not using it that much. That's through our Calyx Point processing. We can pull valuations direct from Fannie Mae, Freddie Mac. It's a tool that we have. BPO, we have a great firm that happens to be here in Phoenix that does BPOs for us anywhere in the country. We're Arizona, Nevada, which is what we're using right now. And I think they do a pretty decent job. But sometimes I get a CMA I don't like, and so I'll get a BPO. So it's not uncommon for you to look through my files and see an appraisal and a BPO, or a CMA and a BPO, because I'm looking for more. And you know, they'll be all different things.
AVM, is that what they used to call the desktop appraisal?
Yeah.
Okay.
Yeah. And that's the right way to say it. Now it's the automated valuation method. While we're in processing in Calyx Point, we go click, click, click over here, and we pull valuations direct from either Fannie Mae or Freddie Mac.
Because I see them a lot. How do you value them? Yes, or you think they're worth it, or
I haven't looked at one of these in probably over a year right now. So I can't answer that properly for you.
Okay.
Same thing like Zillow tax records.
Well, I've used them a couple of times, and I thought they were close.
It's hard.
Same as
I mean,
Zillow?
and that's why I say you'll look through my files sometimes, and you'll see a couple of
tax
these.
records.
So, and with the market changing right now, you might look at one of my files I've had for 3 months, and there's a CMA in there from 3 months ago, and there's one in there from last week. Because I'm always looking. I want to see what's happening with the comps in that area. Because that note might sit on my sheet as $125,000 value, but maybe there's 3 recent comps and it's really worth $150,000. I think that's worth knowing. So you'll see all that in our files, and you look through all that before you pick one up. Not a dollar leaves here without being covered by hazard insurance. We talked about that. So we're listed Titan and/or assigns. Same with the title policy and the hazard insurance policy. So our note buyers are protected the same way we're protected. Okay. Equity position in the property. The cash out refinance we did for the guy doing the burnouts, right? $60,000, but the BPO came in at, actually the BPO came in at, that's a good description. I think the BPO came in about 127, but off the BPO and our CMA, I valued it about 140. And I think I'm still conservative because I think the BPO drew a conclusion the wrong way. That's why I like to look at comps. There was a perfect model match comp right there just a street away, and it just sold for 140 something. And so I did 140, and I think I'm still conservative. But again, you're at a $60,000 loan. So 127, 140, 152, you got, like I say, that one gone, right? But equity position. Because at the end of the day, if we have to go through that foreclosure process or do the deed in lieu or whatever. What's that?
We get the better property.
Just want to know. Okay, we talked about that. All of our loan files, and I think we've touched on this, deed of trust, it's a traditional loan package. Deed of trust, promissory note with a personal guarantee. Have we had to exercise it? No, but our borrowers know it's there. And I think just the fact that our borrowers have skin in the game and they know that the note has a personal guarantee, I don't know, that's a psychology thing. I think that plays into the fact that they know that we at least have the ability to chase them down if we need to, right? I've had just a few people say, I won't sign the personal guarantee, and I said, well, why would I do that loan? I mean, if you don't have enough faith in that loan to just sign the personal guarantee, why would I do that loan? And I don't. So our loans do have the personal guarantees. You don't want to sign it? Okay. There's probably somebody else that'll work with you on that one, but I'd rather not. Because when he buys the note, I don't want to tell him I was a wimp and wouldn't enforce the personal guarantee. Yeah, we have personal guarantee all the way through, right? Title policy, we're title insured on everything, okay? We have a 3-check process for our investors that buy through InfoClosure, like the gentleman who just bought the property and put 40% down. So when he's successful at auction, we know from 2 different title sources. One, we want to make sure that that's a first lien position, and we're not foreclosing on a second lien position, and then whoops, we're no place good. What are the taxes on this last one that came through? There was a couple years taxes due, and there was something from the city of, where was that property? City of Surprise. There was $700 refuse collection bill or something like that. But we collected the $700 from him. We contacted the city, and they said, you know what, we're not sure on that bill. We'll let you know. But we're going to sit on the $700 at least during the duration of our loan, and if it comes due, we'll pay it. If not, he pays us off. He'll get us $700 back. Meantime, it sits in our reserve. And taxes, right? What else are we looking for, Johnny, on those title? But
Everything,
Yeah.
federal, everything.
yeah, but we know, and sometimes we get a buyer who's identified a property at auction, and they're all set to go, and we get all kinds of title stuff in, and it's loaded with hair. I mean, if the buyer wants to do it, that's great, but we won't do that loan. Okay? Because again, the last thing you want is you don't want to have a good loan with a bad title, and then you go to foreclose and you got all kinds of issues. You probably know about that.
And then on our side of it, we'll suggest stay away from
Right.
Which title company downtown?
Right now, we're using predominantly Empire Title, who's underwritten by Old Republic and First American. You know, you've got different title companies who are ultimately all supported by the majors, but Empire Title, they just give us great service. You know, we get commercial rates all the way through. They take good care of our clients. They do a lot of our research through InfoClosure. And are we using Sterling now yet? We're using Sterling. You know, but again, a lot of these companies are underwritten by First American, Fidelity, Old Republic. We had the president of Old Republic in here last fall doing a presentation on title for all of our investors. Pretty impressive. Our trustee, you asked, Michael Tafoya, was Bosco prior to that. 90 days to auction or 6 months, debatable, but if you've been through it. Determining opening bid, that's just if there's a default, what happens, and we kind of talk through that process, so I think you guys are pretty clear on that. You might be more clear than I am. The good news is, I don't know about defaults. Maybe that's okay, right?
Yeah.
Why? Right? I don't want to know about it. Who are we, long-term relationship? Again, I'm 24 years in this space, joined Rick in late 2010. Absolutely love the real estate and lending environment, and I like the space that we're in. And by bringing in note buyers, we're able to generate additional capital and satisfy the demand for our borrowers out there. I love what I do. We've got Troy Vanderberg, who's been with us for a year now. He comes from the securities field and insurance field, and he's tied in with investors on the securities side and brings in different investors and note buyers. Cole Strebel is our branch manager at our office. We have a physical office in Las Vegas, and Cole comes from Wells Fargo Private Client Services for the last few years, like myself and Johnny. He's been a mortgage banker for a long, long time, and he's having fun writing the private money deals over in Vegas for us as well. Ashley Child, yes, there's a similarity there. My oldest daughter, been with me for 2 years here now. My first grandchild on the way, end of September. I know I look 30, but I'm having my first grandchild, so. And then again, we adhere to Arizona, Nevada, and soon California licensing guidelines and restrictions. So we've been through 2 audits in Nevada, 1 in Arizona, clean bill of health, you know. But that's going to become tougher starting next year. The state licensing authorities are looking for ma and pa investors, and that's why I think ma and pa investors are coming to places like here where they can still make the investment, but they don't have to go out and sit at the title company, do the closing, collect the payments, and adhere to any licensing guidelines and rules and regs and all that stuff. Positive cash flow, again, knock on wood, hopefully any one of our note buyers is buying a note that's performing, okay? If we have one that's not performing, probably not gonna have you buy it. But you start earning right away. We sold a note a couple months ago to a gentleman. The borrower was in his second 12 months, so we did a 12-month loan, and then he renewed for another 12 months, and he hopes sometime in this 12-month period of time he'll be able to take us out conventionally. He's traveling, he's a computer guy, always in different parts of the country, and has the house rented out to his sister and her family, so that's how it's an investment property. But he makes his payments every 2 or 3 months, because he's traveling around doing all the rest of that stuff. We're in our second 12-month loan period with him. Once he gets past 30 days, I call him, I start busting his chops. He always gets back to me, he always pays us up with the late charges and does that, but he's a sporadic payer. But I found a note buyer who drove the property, looked at it, looked at the loan package, liked it, and I sat down with him and I just said, here's the history on that. So here's what you're gonna see, so I don't want you to be surprised, and if you don't like that, then don't take this note. But that's the benefit. I can sit there and say, okay, you might see your payment every 60 days, but the late charge will come in with it. So your 10.5 might actually spike up to 11.5 or 12. But just know that it's a sporadic pay, and if you don't want it, then that's the case. Well, if we've had a loan that's been on our books like that, I can give you the history on it. If we have another one like down in the Capital District where it's just a new one, I don't have the history, but you still get a look at the loan package like I do. But you're gonna go 60 against the 140, good, on a nice piece of property. And then we talked about what happens at the end of 6 or 12 months. And again, we try to always work with our borrowers within reason, especially if they're paying up on time and they're good borrowers. Question? Good. Favorable tax treatment. Vantage and Accuplan are the 2 firms locally. There's others. We had one of our note buyers works with UDirect IRA. You know, people do different things, but the fact that IRAs can come into this space and earn the 10.5%, the distribution security title sends them directly to the IRA, so it goes right in there on a monthly basis.
The bigger brokers don't do this, or?
The bigger brokers that we found, like a Fidelity and some of these other places,
People like that,
the investor might have a self-directed, but they won't manage it in this way.
Okay.
So there's these firms, Vantage is up in North Scottsdale, and Accuplan I think is over Fountain Hills or East Valley. It just happens to be 2 that we work with, and they've approved our note packages, and it's a real easy system. So we like them, but there's others, but there's some of the big ones that don't do it. Above average return paying rates to 9, 10.5. Currently, everything we have is 10.5%. Now, if there's a certain note that is worth 24 months at 12%, and I collected 4 points on it plus fees, and it's a 50% loan to value, you know, all kinds of great things, we're going to have a lower rate on it, much lower risk, and the rate to the note buyer is going to be lower. But typically, when we have those, they go quick, as you might imagine. And yeah, you'll take a little bit less, but gee, you're 50% loan to cost, you know, all these other things. Were you raising your hand, Johnny, or no? No, okay. And that's where, again, varies based on equity and risk. Why buy notes from Titan Capital? You're in control of your investment. You guys know where we are. You asked. You can drive the properties, look at them, kick them, see them. Immediate consistent cash flow because the notes we're presenting are performing. The security and safety, again, by the equity, the due diligence that we've already done. We're not asking any note buyer to buy a note that we're not already sitting on ourselves. It's probably the best thing for me to say. If you don't buy our notes, like I said earlier on, all our capital's deployed, and Johnny and I are off playing golf. And then all I have to do is chase down the payments every once in a while.
Is that to say 100% of your notes are for sale?
We have some notes that we're not putting out for sale, but right now we're at about 2.5 million of notes that are available. So pretty much everything. I'm trying to come up with the right way to answer that. We have some that we're not selling, but most everything.
How do you make that choice, or is that something you can't, or choose not to answer is fine?
Well, I'm trying to come up with the right answer.
If we were in Chicago, you could say, forget about it.
Forget about it, up the wazoo.
And it's fair not to answer it.
Well, if I'm concerned about a note, I'm not going to put it up for sale. If it's about to pay off, I'm not going to put it up for sale. One of the notes on here is a construction loan that we have in Flagstaff, but I'm probably not going to go through the hassle of letting anybody buy it right now because it's going to pay off in probably 30 days. So they're just different things. Either I'm concerned, or it's about to pay off, or it's something that we're just, maybe it went with our own dollars, we're not paying an investor on it, so we're getting a bigger return. Could be different reasons like that. But most of what we have is up for sale. If I'm making a note available to a note buyer, I want it to perform. Because I don't want you buying a note and then going, yeah, I went to see these guys, I met them, learned it, I liked the note, I liked the home, I liked everything else, and 2 weeks later it went into default. That's not a very good track record for us. So what we have available, I want to make sure performs for you guys. Security, safety, IRA friendly, outstanding team. Short and long-term notes available. I say short and long-term, 6, 12, and 24 months. And you guys will see the terms on here. I'll give you that. And then we wrap it up with the steps to buying notes. You can make an appointment with me. You can visit with me after this. You can go to the website. What we post here, what I'll give you guys today, is also available. If you go to our website, there's a Buy Notes tab. You have to register, but it's just to capture who you are, just name and phone number and an email. And then you can view, and Ashley goes in about once a week and updates what we have. So there actually is a process where you can actually buy the note through the website, and I didn't know that we had that set up, and I got an email that said somebody had bought the note through the website, and this gentleman called me from Lake Havasu, said, hey, when are you signing out my paperwork? I'm like, okay. I missed that. Saw the email, but now I know what that is. So he went through the whole process of buying a note on our website, which you can do just like buying something online at a department store. And it notified me, and shame on me, I didn't know what it was for a couple of days, but we got the note processed and got it shipped up to him. So, but through the website, the Buy Notes tab, register and do that, review the notes you're interested in, schedule an appointment with me, come in and talk about it, look through the borrower file, if you're right here, or I can scan you the borrower file. We're very transparent. If you're going to make an investment, you're basically taking our position in that investment. You're going to have what we have. You're going to have the security, you're going to have the borrower file, everything through. So,
do you have examples of your note or mortgage agreement?
I do.
So that we'll see all those terms and conditions?
Yeah, if you make sure to either email me or give me your email, we can send you a sample of our note and deed of trust, so you can see it exactly. And then we can send you the note documents that get executed. And we have just blank generic forms that you can go through. So thanks for asking that. This one went a little longer than usual just because I think there was good discussion, but thanks all for staying. Let me give you guys each a list. Give you that.
Thank you.
Sure. And like I said, we rolled this program out about a year ago. I went to a gentleman I've known for over 20 years who's done nothing but notes for his private money firm for 20 years. And we're friendly competitors. He came in, got us all set up. And in that period of time, less than a year, I think we're up to about 40 note transactions now with note investors. So welcome you guys anytime. So I know you're interested. But call me, set up an appointment, or visit with me now after if you want. And any other questions I can answer you guys?
Did you say all of these are paying 10.5?
Yes.
That's not on here though, right? We just.
No, it is.
Oh, it
If
is.
you go through here, here's what we try to clarify in here. The lien position is the first. Now the property address is typed right above the box. Okay. So the first note, if you go to the right side, it's our loan number 10302.
Oh, I see 10.5. Right
It's a
there.
first lien position. It's a loan amount of 305. It's 10.5, and then you can go down and you can just see that everything's 10.5.
I don't know how I missed it.
That's right. The 10.5, and everybody keeps asking this, but not just you guys, but other note buyers, the 10.5 is a true net. So when we set, thank you very much. When stuff goes to security title, it's a $100 setup fee because we don't have impounds. It's like $250 if you have impounds, but it's a $100 setup fee. So when we send everything to security title, we send our $100 check, and then the servicing is $12 for the first check and $6 something for the second check. So it's about $18.50. So each month for the 2 checks that come out of security title. So let's take the 10.5%. Let's just say your portion of that distribution, for simplicity, is $1,000. You get your $1,000. No, there's no fees. There's no extra cost. There's no setup fees. We've already paid it. And then let's say you get the $1,000 and we get $500. We get $500 minus $1,850 or $1,875.
So the
whatever
fees
it is.
come out of your side, basically.
Come out of our side. So your 10.5 is a true straight net 10.5. I really appreciate you guys coming in.
The first loan, the maturity date is April 1st, 2013. If this was produced in June, is that?
This is the one that's the construction one up in
The one he
Flagstaff.
keeps extending?
Yes.
Okay.
Well, he asked for about 60 days more, and so if you told me right now you wanted to buy that, I think he's about 30 days away from paying off, so I probably wouldn't. I probably should, this is one of those I should probably move off the list.
Gotcha.
But
Most
it's,
of the time, the security date is the end of the deal.
yes,
typically.
yeah. But again, I've got such a good history with him. You know, if he goes more than another 30 days and all of a sudden tells me he needs another 6 months, I'll probably renew him. Or needs another 60 days, I'll probably put a new 6 month.